Hi, welcome to Yield on Cost Investing, a channel that educates dividend growth investors. We will have timestamps in the description, so you do not need to watch the whole video if you do not have time. Expanding on our previous video, what is yield on cost and why should I care? I would like to give some real-world examples to the numbers I displayed in the first video. Transurban in 2009 is an example of a blue chip stock that has a high starting yield because of temporary bad news or a recession. In this video, we will give a case study of this scenario. To continue this analysis, I will log on to Guru Focus. As you can see, in December 2008, Transurban was trading at $4.81. Concerns about the global financial crisis and the flow-on effect to interbank funding sent Transurban's share price tumbling because it needs debt to operate because of the very high capital requirements it has as an infrastructure business. Transurban's dividends per share in June 2009 is 21 cents. Note, this is the annualized figure, meaning it combines all periods of payment in that financial year, hence why we bought the stock in 2008 before the interim dividend was paid. A simple division of 21 cents divided by $4.81 times 100 gives a starting yield of 4.3%. We will model this in Microsoft Excel, but first I will find out the average dividend growth rate in the period from 2009 to June 2008. Over a 9-year period, Transurban's average dividend growth rate was 11.33%. I will demonstrate the significance of this right now. As you can see, this is a real yield adjusted for inflation of 69.02%. I can magnify the ending cash balance more if I add deposits on top of the initial investment. I will add just $1,000 per year in this investment. Note, this deposit is added before any dividends are paid in that financial year. As you can see, the returns are quite satisfactory. Now let's discuss why the Transurban example is important and relevant to yield on cost investing. I know what you might be thinking. Anyone can cherry pick data. Many companies that fall that much in price never go up again. What makes Transurban so special? To put simply, it has a strong competitive advantage. An oft-repeated saying of Warren Buffett is to buy a business that has a moat around it. This basically means it can keep generating consistent profits that are significantly above the average return on capital in their business sector when compared to their competitors. The significance of this is that a strong competitive advantage becomes more profitable to hold over the long term instead of the short term. This is because the compounding is so good. Transurban is close to having monopoly-like status. It owns and operates 16 of the 19 toll roads in Australia. In spite of this impressive market share, it is not regulated like a monopoly is. The reasons, in the words of the Transurban CEO, is that people have a choice whether they use a toll road or not. They can merely bypass the road and take an alternative route. Secondly, Transurban does not set the toll prices. These are set by the state government where the toll roads are located. The Australian Competition and Consumer Commission has cleared their successful bid of WestConnex last year in June. So this means Transurban basically will still not be regulated. Why is that, you might be asking? Why indeed? The reason is an economic one. The very high cost of building infrastructure essentially creates what is known as a natural monopoly. Basically, this means that once a tender has been awarded, if another competitor wanted to build a cheaper toll road nearby, the act of taking market share will result in both toll roads being unprofitable. So the end result is that there would be no toll road. Therefore, it only makes sense to have only one toll road unless there's significant geographic distance between the two competitors. Considering Australia's continuing population expansion, this will give Transurban a steady, ever-increasing cash flow stream. Increases in toll fees by the government are linked to CPI plus an additional 2 to 3%. Although Transurban had an interest coverage ratio below 1, its revenue only dropped on a per share basis from 61 cents to 60 cents. But besides this, the revenue trend has only been up. There are only two situations when the free cash flow was negative. One in 2011, when there was 460 million in negative free cash flow, and 2018, where there was 207 million in negative free cash flow. Besides these years, on an annualized basis, Transurban's free cash flow has been positive. Moreover, it had the same advantages mentioned above, such as the economics of natural monopolies. Arguably, it would still have been a great investment back then. At Yield on Cost Investing, we aim to educate, entertain, and help our viewers be better dividend growth investors by giving them the knowledge to think independently so they can become better long-term investors. If you enjoyed the video, please like and subscribe for future content.